Imagine for a moment you're trying to make truly smart trading decisions in the stock market. Not just based on, a gut feeling or what some talking head on TV said, but on rigorous data and powerful computing. That's really the world of algorithmic trading. And our mission today on the deep dive is to pull back the curtain and uncover the core principles of building, testing, and optimizing machine learning strategies for stock trading. We'll explore how these complex models are designed, why proper testing is absolutely crucial, how some common pitfalls can completely derail a seemingly perfect strategy, and finally, how to make these complex systems run at, well, lightning speed. Consider this your shortcut to understanding the mechanics behind high-frequency trading and smart investing. So, okay, when we talk about using machine learning for trading, where do we even begin? Is it about trying to predict the exact price or something else entirely?
Right. But the primary goal really is to classify the current situation of the stock. Is it a definite buy, a clear sell, or maybe just a do-nothing action right now? We use machine learning for this, building these models based on historical data. Think of your historical data like a massive spreadsheet. Each row is a specific moment in time, moving chronologically, left to right. And each column holds a specific piece of information or feature about the stock, things like its price, trading volume, or other calculated technical indicators.
Okay, so we're looking at historical data, the factors we know, the X values to predict a future outcome are Y. But here's the fundamental challenge, isn't it? How do you even begin to teach a system to predict something as inherently uncertain as the future market, especially when its training data is, well, by definition, historical?
Yeah, that's a really important question. For training, we essentially go back in time. So on any given historical day, we look at the features, those X values, and then we observe what actually happened to the price in the, say, near future. For instance, if we're trying to predict 10 days ahead, our very latest training data point has to be from 10 days ago, because that's the point where we already know the outcome, right?
Yeah.
So this pairing of historical features and known future outcomes lets us train the system. We step forward one day at a time, continuously learning from what happened.
Okay, got it. So once you've got a model, you obviously need to test it thoroughly. My first instinct, honestly, would be to just run it over the same data you trained it on. That sounds logical, right? See how well it learned.
But here's a critical insight. Testing your model on the same data you used to train it is, well, it's totally bogus. It's basically doomed to succeed. It's like getting a copy of the midterm exam 3 days in advance.
Yeah.
And then taking the exact same exam. You'll get fantastic results, sure, but they're completely meaningless for predicting real-world performance. That's what we call in-sample backtesting.
Okay, so that's like academic cheating. How do you avoid that in the real world of trading then?
The correct method is something called roll-forward cross-validation. You essentially roll back time to an artificial today. Then you train your system only on data that existed before that date. And then you make a forecast into the future, maybe 5 days ahead, for example. Crucially, you are absolutely not allowed to peek at what really happened in that future period.
Okay.
So once you make your forecast, you enter your orders, you trade, and then you observe the outcome as time actually advances. And a crucial practical point here, if you base your information on market close data, you can't actually trade until the next day at the earliest. Because
Right.
it's just not feasible to act on something at the exact same moment you observe it.
Makes sense.
Then you rebuild your model with the newly available data, and you repeat the process. And it's important to always train over a consistent amount of time in the recent past, not, all the way back over all historical data. Older market regimes, as we call them, can really muddle performance. They might not be relevant anymore.
Okay. That sounds very different from standard cross-validation, where you might just slice the data into, say, 10 pieces and test on each one, regardless of time order.
Exactly. With stock data, time matters immensely. You can only test on slices that are in the future relative to your training data. You can't just slice up the last 10 years and test on a piece from, 10 years ago after training on more recent data. The reason it's kind of weird, but the way the market behaves in the future is actually extremely predictive of the way it behaved in the past.
Really? That sounds backwards.
It does sound counterintuitive, but it's often easier to predict the past than it is to predict the future because market regime changes can be, well, irreversible. So if you test against past data after training on future data, the results are unreliable. You just can't trust them.
Okay, wow. So we've talked about the dangers of in-sample testing, but I think the source mentioned something like 9 ways that backtests can mislead you. What are some other really significant pitfalls we need to watch out for?
Yeah, there are quite a few. One really common trap, even if you are using roll-forward cross-validation, is what you might call the in-sample fallacy through constant tweaking. So if you keep adjusting your strategy, like maybe changing from linear regression to decision trees, or swapping this factor instead of that one, based on how it performed over a particular historical period you just tested,
Of
you're
course.
essentially baking in knowledge you wouldn't have had in real time.
Right, you're curve fitting to that specific history.
Exactly. The solution is to do all your initial testing and tweaking over an earlier, genuinely separate historical period. Like maybe decide you won't go past 2010 for your initial development. Find your best model there, lock it down, and then let it run forward on genuinely unseen data. That gives you a much truer measure of its potential.
That makes sense. Another fascinating trap mentioned was survivor bias. That sounds like something straight out of a medical trial, doesn't it?
It is. It's the exact same concept. The sort of official description is the selective use of data in a statistical study that emphasizes examples that are still present or alive.
Mm.
Think about a drug company doing a 5-year study on blood pressure medication. If, say, 58 of their 500 patients died during the study, and they happen to be the ones with the highest, most dangerous blood pressure, then by the end of the study, you're only testing the people who lived, who are kind of by definition going to be in better health.
Okay. I see how that would skew the results. So what does this mean for stock trading? How does survivor bias show up there?
It's the precise same principle. If you test a trading strategy today using only the current members of the S&P 500 index, you're only looking at stocks that successfully survived through all the market downturns and changes. For instance, something like 58 of the companies that were in the S&P 500 back in 2008, 2009 are gone now. They dropped out, got acquired, went bankrupt.
Wow.
So using today's S&P 500 list and applying it historically gives you this sort of built-in 13% advantage just from implicitly filtering out all the failures.
13%. That's huge.
It is. So if some, young whippersnapper comes along and shows you a strategy that outperforms the S&P by 13%, and you find out their universe was the S&P 500 as of today, they're essentially cheating, even if they don't realize it.
Right.
To prevent this, you need proper historical membership data for indexes. You need to know exactly which stocks made up that index on every single day in history. Companies like Lena and the big hedge funds like Citadel, they pay a lot of money for this kind of precise data.
That's wild. So, okay, let's say we manage to get our data perfectly clean, avoid survivor bias, use roll-forward testing. Are there still other ways our seemingly perfect backtest could mislead us in the real world?
Oh, absolutely. This raises a really important question. Market impact, or sometimes called slippage. Even if your system is genuinely predictive, the very act of engaging the market with that information, placing your buy or sell orders,
Yeah.
can actually cause the price to move against you. And that movement can nullify the very advantage you predicted.
Okay, tell me the story about the strategy with the Sharpe ratio of 7. That just sounds possibly good.
Right. Yeah, my boss at a hedge fund out in California, he saw this strategy someone developed, and they had this absurdly high Sharpe ratio of 7 in the back tests. And his immediate reaction was, no way that works in real life.
Healthy skepticism.
Exactly.
Yeah.
So we started trading it cautiously, maybe $1 million against it, and its performance just went horizontal, completely flat. It didn't make money anymore. So we stopped trading it to overhaul the code. We were certain we must have made a mistake, somehow managed to peek into the future in the simulation, but we combed through it, and there's nothing logically wrong. And here's the kicker. When we stopped trading it live, the back-tested performance, looking back, it picked right back up. It did this, gestures upwards.
Wow. So stopping the trading fixed the back test. What was happening?
We finally figured it out. We discovered we were trading really thinly traded stocks. So imagine a stock that maybe only has $50,000 worth of trades in an entire day. If we come in and try to trade $10,000 worth of it, suddenly we're 20% of the entire day's volume.
Right. You're the elephant in the room.
Precisely. We were crushing the price when we bought, pushing it up against us, and crushing it down when we sold. We calculated we were losing about 24 basis points. That's 0.24% just from this slippage on each round trip. But our actual prediction advantage, the edge the model found, it was only 20 basis points. So, yeah, we were destined to slowly lose money, even though the signal was technically correct, just because of our own market impact. The backtest never saw that coming.
That's a fascinating point about these market inefficiencies. So why do they even exist if they can be predicted? Why haven't big players wiped them out?
Well, they exist precisely because for the really large hedge funds, like Citadel you mentioned, it's simply not even worth their while to consider touching a stock like that. They can't deploy serious capital. They can't buy $20 million worth of a stock that only trades $50,000 a day.
Right.
They totally obliterate the price and destroy any potential profit long before they built a meaningful position. So the big players, they haven't pointed their massive guns at these tiny opportunities. Now, smaller traders like our, young whippersnappers in their garage, they could potentially exploit these things. If they find, say, 500 different stocks that are thinly traded like this, and they just buy maybe $100 worth of each one, that might work. But the key point is that every strategy have a capacity. There's a limit to how much money you can trade with it before you start impacting the price too much. And eventually, as more capital gets deployed, that advantage just evaporates.
Interesting. One quick follow-up on that market impact point. Is influencing the market price like that even legal? When does it cross a line?
It's, uh, it's not always perfectly well defined, legally speaking. Directly buying a stock and impacting its price through legitimate trading activity is generally considered permissible. That's just how markets work. What's being agitated about more recently and regulators are looking at are tactics like spoofing. That's where someone puts a large order into the order book, maybe a buy order just below the current price, lets other traders see it and react, revealing their own interest, maybe placing orders ahead of it. And the original trader just takes their big order out within milliseconds before it ever gets executed. They were just faking the interest.
Ah, okay. Using it as bait.
Exactly. That kind of thing isn't universally illegal yet in all contexts, but it's definitely a significant regulatory concern and gray area.
Okay. So let's say you've navigated all this. You've got your model, you're carefully backtesting using roll-forward validation, you're accounting for survivor bias, you understand market impact. But what if your carefully constructed strategy is just too slow? Too computationally expensive to be useful in a fast-paced market?
Right. That's where vectorization comes into play, and it's super important for practical application. The specific project we're discussing here involved creating a custom technical indicator, kind of a basket of signals, and a trading strategy based on it. The strategy was looking for divergence between a specific stock and the broader stock market index, like the S&P 500. The idea was the strategy would go long whenever the stock appeared to be oversold according to its indicators, but the overall index was not oversold.
Okay, so buying weakness in a strong market.
Kind of, yeah.
Okay.
Or conversely, it would go short if the stock seemed overbought, but the index was not overbought. And then positions would just be closed whenever the stock's price crossed back through its moving average.
Interesting. So what kind of indicators went into this custom basket indicator?
We use three main ones in this example. First, pretty simple, the price to SMA ratio. That's just today's price divided by its simple moving average. If the ratio is 1, you're right at the average. Greater than 1, you're above it. Less than 1, you're below. Second was Bollinger Bands percent. This basically normalizes the price relative to its Bollinger Bands. It goes from 0% at the bottom band to 100% at the top band. And remember, those bands are typically calculated as the SMA plus or minus 2 standard deviations of the price, so it tells you how stretched the price is.
Okay.
And finally, we use the Relative Strength Index, or RSI. This is a popular momentum oscillator. It tries to predict when a stock might be reaching a short-term high or low based on recent price action. Technically, it's a ratio comparing, on days the stock goes up, how much does it go up on average, divided by on days the stock goes down, how much does it go down on average over a certain look-back period. Typically, an RSI value below 30 is seen as indicating the stock might be oversold, and a value above 70 suggests it might be overbought.
Got it. 3 solid indicators. So how slow was the initial straightforward code for this? The version written with, normal loops?
Yeah, the first version, the fully iteratively written code using standard nested loops for all the calculations. It took 5.5 minutes to run. And this was on a pretty new MacBook Pro at the time. Now, that was looking at 7 years of daily data for just 7 stocks using those 3 indicators and a 14-day look-back period for the calculations.
5.5 minutes. Okay, that doesn't seem that terrible at first glance, maybe for an end-of-day strategy.
Right, it might not seem that bad initially. But think about scaling up. What if you want to test this on the entire S&P 500? That's 500 stocks, not 7.
Yeah?
Or maybe the Russell 3000. Or what if you want to test dozens of different indicators or much longer look-back periods? Suddenly 5.5 minutes turns into hours or even days. You may not live until you see your answers.
Okay, point taken. That's definitely a problem for rapid development and testing. So how did you get it to speed up so dramatically? What's the magic of vectorization?
The approach generally is, first, get the code working correctly. using the simple iterative loops. Make sure the logic is sound. Then, one step at a time, try to replace each loop with equivalent vectorized code that operates on entire arrays or columns of data at once, usually using libraries like NumPy or Pandas in Python. And critically, after each change, you must ensure the output remains identical to the original loop-based version. So the first obvious step, the real low-hanging fruit, was eliminating the innermost loop used for calculating the simple moving average and the standard deviation for Bollinger Bands. Instead of looping through 14 days for each stock on each day, you can define that 14-day window as an array slice and perform a sum or standard deviation calculation in a single vectorized step.
Wow.
Just changing those couple of lines immediately resulted in a 66% faster execution. We went from 5.5 minutes down to about a minute and 50 seconds.
Wow, just from that one change.
Yeah. It really shows that even fairly simple vectorization changes can lead to dramatic improvement, especially on the tightest loops.
That's a huge jump already. What was the next step after tackling that inner loop?
So next we targeted the second loop, the one that iterated over the different stock symbols. We changed the SMA calculation again, so it processed all 7 symbols simultaneously in array operations. That yielded another 35% speed up. But the biggest gains usually come from eliminating the outermost loops, the ones iterating over time. For something like a 14-day sliding sum, which you need for the SMA, there's a clever trick using cumulative sums. You calculate the cumulative sum of the price series up to today, and then you subtract the cumulative sum from 14 days ago. The difference gives you the sum for just that 14-day window, but you calculated it across the entire time series in basically one vectorized step, no looping required.
It's over.
Yeah. Now, for RSI, that one was genuinely hard to vectorize because it involves conditional logic separating up days from down days. So what we did was pre-calculate the daily price changes, the returns. Then we used the powerful where clause functionality in NumPy, which is basically array-based Boolean indexing. We could say, find all the positive returns in this 14-day window and sum them, and separately find all the negative returns and sum their absolute values, all in vectorized steps. That change alone led to about a 60% faster improvement for the RSI part. And libraries like NumPy are smart. They even anticipate things like potential divide by zero errors if there were no down days, for example. They'll often assign a special infinity value, which you can then handle afterwards.
Okay, that covers the indicators. But what about the actual trading strategy logic itself? That had, 4 different conditions, plus it needed to know if you already had a position. How do you vectorize that?
Yeah, that was tricky. First, we had to switch from using a standard Python list to store the generated trade orders. Lists are flexible but slow for this. We moved to a pre-sized NumPy array. Then, to handle the price crossing the moving average condition for exiting trades, we created a crossover indicator. We made an array that was, say, 0 when the price was below the SMA and 1 when it was above. Then, if you take the difference of that array from one day to the next to function, you get a 1 wherever there's an upward cross going from 0 to 1, and a minor 1 for a downward cross going from 1 to 0, and zeros everywhere else.
Neat trick.
Yeah. Then, for the main entry logic with its multiple conditions, stock oversold, index not oversold, etc., we applied the entire set of rules using a compound Boolean index. This means combining multiple conditions, using for AND and for OR, operating on the entire arrays of indicator values at once. This gave us Boolean arrays telling us exactly when the long entry or short entry conditions were met across all time and all stocks simultaneously. Based on these conditions, we calculated our target shares, basically, an array saying on any given day, do we want to be long, +1, short, -1, or flat? But you don't trade every day, so we use a forward fill function to carry forward the last target position through days where no new entry or exit signal occurred. And finally, taking the diff of this target holdings array gives you the exact changes needed day to day, which is precisely your array of buy-sell orders.
Wow, that's quite a transformation from simple loops to complex array logic. And the end result of all this optimization, what was the final speed up?
By fully embracing vectorization, replacing every loop, we achieved over 1,000 times faster performance.
1,000 times.
Yes. For the exact same logic, producing identical output, we went from 5 minutes and 24 seconds down to just 0.35 seconds, less than half a second.
That's incredible. That changes everything in terms of what you can test and how quickly.
Absolutely. It's not just about raw speed, though that's nice. It unlocks the ability to rapidly iterate on hundreds, even thousands, of strategy variations. You can adapt to shifting market conditions much faster, test more complex hypotheses, explore interactions between dozens of factors, things that would just be computationally impossible with the slow iterative methods. It's a really powerful demonstration of how Understanding your data structures and using these vectorized operations can completely transform computational efficiency and, by extension, the scope of what's even possible in algorithmic trading.
What a deep dive that was into the fascinating and frankly complex world of algorithmic trading. We've really seen how machine learning models are used to classify stock movements, not just predict prices. We've understood the critical difference that proper roll-forward cross-validation makes for creating reliable backtests that aren't just, wishful thinking. And we've uncovered how insidious biases like survivor bias and the often overlooked market impact can completely mislead you, even with seemingly perfect data and testing methodology.
Exactly. And then we wrapped it all up by looking at the incredible power of vectorization.
Mm.
We saw how applying some clever computational tricks, moving away from loops to array-based operations,
Yeah.
can turn a painfully slow, almost unscalable process into one that's literally 1,000 times faster. And that speed is what unlocks the ability to test truly complex strategies over vast amounts of data and iterate on new ideas incredibly quickly.
So, what does this all mean for you, the listener? Well, whether you're actually building financial models yourself, or maybe you're just curious about how this high tech side of the market works, understanding these core concepts, the classification, the careful testing, the hidden biases, the need for speed, it's really key to discerning potentially valid strategies from the ones that are likely misleading or just won't work in practice. It's a real testament, I think, to how the right data, properly understood, rigorously tested, and efficiently processed, can truly unlock new possibilities in financial markets.
And thinking about all this, especially the market impact and capacity constraints we discussed, it really raises an important final question, doesn't it? If even the most sophisticated high-speed algorithmic strategies eventually run into these limits, does finding true, repeatable alpha, that elusive edge in today's highly efficient markets, ultimately depend more on uncovering these obscure, thinly traded corners where the big players can't compete? Or is it more about simply out-executing everyone else in the main markets by just a few critical milliseconds? Where does the real sustainable edge lie now?